Hello, my name is Maria MacNamara, and I'm privileged to be with Brian Hartzer today in a conversation about fintech in Australia. Brian Hartzer is an experienced executive, leadership mentor, and investor who served as CEO of the Westpac banking group from 2015 to 2019. Prior to his time as Westpac's CEO, Brian spent 15 years in senior executive roles at major banks in Australia and the UK. These roles included CEO at Westpac and divisional chief executive roles at the Royal Bank of Scotland Group and ANZ Banking Group. Brian's banking career has had a strong emphasis on the use of data. He set up the database marketing department at ANZ in the mid-1990s, headed ANZ's credit card and consumer finance business, and he currently works as a senior advisor to both Sayers, which is a Melbourne-based investment and advisory firm, and to Quantium, a Sydney-based data science company. He's also an angel investor in and advisor to several fintech and technology startups. Outside of commercial life, Brian serves as a trustee of the Australian Museum and is chairman of the Australian Museum Foundation Trust. He graduated with a degree in European history from Princeton University and is a chartered financial analyst. Brian holds US and Australian citizenship and he lives in Sydney. Welcome, Brian.
Thank you, Maria. Thank you very much for reminding me of all that.
What a stellar CV. I mean, you've done so much and you're always ahead of the game when you reflect on that CV. So after a career at the big end of town with ANZ and Westpac, what do you see in Australia's fintech ecosystem that attracted you to put some skin in the game as a board chair, advisor, and also as an investor in fintechs like Beforepay and Nano Home Loans?
Well, Maria, I think that the fintech scene, if I can call it that, in Australia has been going for probably a good 7 or 8 years now. I think there's a couple of reasons for that. One is that the Australian banks historically have been quite advanced in their use of technology. It's a relatively concentrated market, 4 big banks, a number of smaller players. And because of distance in Australia, because of the small population, which then creates challenges for staffing things, we've been forced as banks to use technology and have been, a number of the Australian banks have probably had some of the leading mobile banking apps and the like. And so you started to create this group of people who were focused on the use of technology. And because you tend to have things concentrated in a couple of cities, that creates a level of dynamism. It's not as spread out as probably in some other countries. And then I think in recent years, you've had the growth of some fintech-oriented VCs like Reinventure, and you've had a couple of very successful Australian startups, including probably one of the biggest fintechs of all, Afterpay, who've started in Australia and now gone to the world and been very successful. And of course, that creates a level of excitement and energy that brings other people into it. So from my standpoint, Australia seemed like a really dynamic place from a fintech point of view. My whole career has been in financial services, fascinated by technology. I got to dabble with it a bit when I was at Westpac, and finding myself with more time, it was kind of fun to jump in and really spend all my time focusing on it now.
So reflecting on the institutions that you worked in and your experience now, what are the underlying trends that are driving financial institutions to change their focus? You alluded to a couple of them a moment ago.
Yeah, so I tend to think about this as demand side factors and supply side factors. On the demand side, if you think about the acceleration in the use of digital for everything in our daily lives, COVID's obviously been a massive part of that. I think there's a McKinsey study that says that COVID has driven a 5 to 7 year acceleration in the adoption of digital in people's daily lives. And so that obviously is a factor. The high quality of broadband now means that you can deliver services in a way that historically you couldn't. Broadband, particularly in Australia, is essentially ubiquitous. And so you've got new service quality that you can deliver. You've had people become expecting higher quality experiences through their work in non-financial applications like, say, Uber or Deliveroo or some of these other things. People get used to that. And I think there's another factor, which is people are getting used to trying new brands. You think about them moving from PowerPoint to Canva, or moving from using a credit card to using Afterpay. People are just getting more used to trying things and recognizing that their lives can be improved through use technology. So that's creating a pull factor. On the supply side, I think there's a number of really important technology developments. So one would be the standardization of tech platforms. So historically in banks, everything was customized. Now people are increasingly moving to standardized platforms. And that's important because it brings costs down, but it also means that it's easier to plug in SaaS-based propositions to the core infrastructure in banks. So I think that's an important enabler. You have the whole API framework, which is linked to that, which means it's easier to plug pieces into the service proposition. You don't have to build everything custom. You've had great advances in data science, which is creating new uses and new tools that financial institutions can use. There's something that I think is quite interesting called what I call embedded finance, which is, the way I think about this is that historically you had to go to the bank to do something, whether it was to take money out or put money in or make a transaction. Now, the finance aspect, the borrowing or whatever else, can be embedded in the thing that you're trying to do. Because in the end, most financial services are actually an enabler of something else that somebody wants to do. And so I look at things like Afterpay and Zip as embedding the use of credit in the purchasing versus having to go to the bank and apply for a loan. And I think that's playing out in lots of different places as well. And then finally, on the supply side, you've got this really interesting phenomenon of crypto and the use of the blockchain and the ability to distribute and share publicly the ownership of assets. And I think that's going to be a tremendous enabler of re-engineering many traditional banking uses like trade finance and foreign exchange and all these sorts of things. So those are the things to me that are interacting, that are creating all these great opportunities.
It's wonderful to see the removal of friction from the experience with all the new technologies, and it's quite heartening to see the banks adopting them. Having invested in Reinventure and made some direct investments in technology plays that your bank was interested in, what did the experience reveal, and what would you do differently if you had your time over?
Well, we thought about it in three ways. So one was the truly disruptive businesses that were potentially going to eat our lunch. And Reinventure for us was primarily an arm's length venture capital business run by some outside guys to go and find and invest in these things that we would never do ourselves, but allowed us to learn what was going on and put us in a position potentially to take stakes or buy these businesses down the road if they proved up and became quite interesting. And I think that worked really well. And not just from a knowledge point of view, but financially. I mean, we invested in Coinbase, for example, and that did extremely well. And there were a whole bunch of other ones that we were able to nurture that have done quite well as well. The second category for me was where we made direct investments in businesses that we thought were adjacent to what we were doing. So at one stage, we had a significant investment in Zip, which is a competitor to Afterpay, and we were working on a plan to integrate their capability into our merchant proposition, for example. And I think I still think that was a good strategy. And I think that's something that a lot of banks should think about, is where are those logical adjacencies? In some cases, we also incubated our own businesses. So for example, we created something called Uno Home Loans, which was a digital mortgage broker. And that was actually our idea, that we found an entrepreneur to go and build. And we had a very large stake in that. And that was a way to engage in something that was arm's length from our core business. In terms of what I would do differently, I think the thing that we knew would be tough, but I think proved up to be particularly difficult over time, was how to connect those businesses back into the core franchise of the bank. And I think in hindsight, the difficulty of that, I mean, some of it is about knowledge, although I think many people in the banks are pretty cluey about what's going on. But a lot of it was about priorities. And that would be particularly because banks had all this legacy technology. And so the difficulty of plugging things in was significant. And also the measures of success that most senior executives have doesn't necessarily incent them to make long-term investments. I mean, when I was there, we did some of these things because we felt it was in the right long-term interest of shareholders. But if I'm brutally honest, you take the Coinbase example. I think Westpac made a profit of something like $600 million on their investment in Coinbase. I don't know the exact number. No one in management benefited from that because the incentives were all about kind of the first year or two's performance. Now, to an extent, as CEO, I would have liked to change that, but actually there's so much pressure on banks from regulators and the shareholder community about how structures need to be set up. It's actually difficult to create the right level of alignment, in my experience, to get managers to really want to prioritize things which may not be significant today, but might be really important in 2, 3, 4 years' time.
It's almost worth considering some sort of an index that rewards the investment in innovative endeavors and ties REM to those endeavors, so that you've got carrot and stick happening when reporting season comes along. And that hasn't happened yet. I'm wondering, if ever, but that sounds like the sort of thing that might be required.
Yeah, it shouldn't be impossible to deal with, but I think just honest, and partly this is kind of shame on me that we didn't crack it, but I think in hindsight, we didn't have enough incentive to get the senior management team to spend the time on these things.
So that has a lot also to do with the fact that you're regulated entities, and you can establish financial institutions the size of the ones you ran. But nobody really wants financial institutions the size of Westpac or Combank or any of your peers to be adventurous with their innovation, like say a supermarket chain. There's a level of risk tolerance that is acceptable, and then beyond that, there's not. Was that your experience? Was that the limiting factor?
I think that's right. I think there are two elements of that. So one is that being large organizations, there's a level of one size fits all when it comes to compliance and oversight. And that is both from the regulators themselves, who might say that they're willing to countenance small attempts at various things, but in practice, the regulatory oversight teams are pretty uncomfortable to make allowances for something different. So they end up imposing the same standards. And then internally as well, the compliance teams don't quite know how to deal with somebody being given an exception. So if you try to do something, you instantly find that you're getting the full weight of a major bank compliance regime imposed on what might be a very small startup or venture opportunity. And I think that's just a practical reality that makes this more complicated for big banks to participate in this arena.
So that's one of the things that many of the fintech founders need to understand about dealing with the incumbents. But how should they be thinking about the market, both domestically and globally? What else should they factor in when they're dealing with large institutions?
Yeah, so I tend to distinguish between things that are truly disruptive, where you've got a business that is going after a profit pool that the traditional players will really want to protect and genuinely see the business as a threat, versus those that are essentially innovation that is building on what already exists. Sustaining innovation, I think, is the technical term. And most businesses, in my experience, are the latter. And yet, I think there has been a sense of anti-bank sentiment that goes through the fintech community. Some of it, I think, is natural, that entrepreneurs need energy. It's helpful to have an enemy, all those sorts of things to keep yourself motivated. But in practice, I don't think that's terribly helpful unless you've got something which is genuinely going to be disruptive and can can sustain itself that way. So I would say, number one, rather than assuming that the existing players are a threat, view them as potentially business partners, albeit there are challenges in dealing with a big bank. Number two is certainly in many of the senior executives that I know in the industry here in Australia, they are actually very well traveled. They are very well versed in some of the trends. They have strategy teams. They're looking at these things all the time. They tend to actually have a pretty good idea what's going on. What they have is constraints, and those constraints are around the ability to allocate resources to things, particularly when it requires people and technology changes, when it requires pushing the envelope on compliance, and they have prioritization decisions that they need to make in terms of how much money they can generate out of something to be able to meet their profit targets. And those sorts of things tend to mean that a very good idea may not get up the priority list, not because it's not a good idea, but because they have these other constraints. And I think perhaps one other constraint I'd mention is reputation. So particularly around crypto, for example, the banks just have zero tolerance for having AML type issues. The regulator on that score, AUSTRAC, is pretty fearsome. And so I think there's been a lot of frustration sometimes in the fintech community about why aren't banks embracing this? They must be threatened by it. I would say they're probably not threatened by it. They're probably just have no tolerance for the potential of a big reputational or regulatory hit off the back of some of these things.
So let's explore the whole regulatory environment a little bit more. I'm interested to understand your views in relation to the RegTech opportunity that exists within financial services sector, given the level of regulation and the inefficiencies that emerge as new regulations and legislation are introduced. What do you see as the potential for, the intersection between the two Venn diagrams, RegTech and FinTech?
I think it's huge. There are not many places in banks that have essentially unlimited budgets, but certainly in a number of markets, the compliance budget in practice is almost unlimited if the organization feels that it's got some work to do to restore its reputation and relationship with regulators. And so at the moment, banks are throwing huge amounts of money, predominantly by throwing bodies at very complex manual processes. And at some point in time, they begin to be more focused on managing those costs effectively. And so I think that will create lots of new opportunities for fintechs who can find a way to automate something around compliance or money laundering or something in the credit process, not to mention monitoring staff behavior, which, there's lots of technical solutions coming along to that, the use of data science to better understand what's going on in an organization, where the risks are emerging, which customers are potentially vulnerable and need to be addressed in a different way. I think there's just endless opportunity there. The problem at the moment is that it's highly customized within each bank. And so it's a little harder to create a standardized solution that you can replicate. But there are examples of companies that have started to create tools that are enormous enablers for people to manage their regulatory costs more effectively.
You mentioned data, and I noticed that you're involved with Quantium. How far along are we in terms of the product lifecycle, or in terms of this level of sophistication in the analysis and the use of data to inform strategy within a bank, and also to create new opportunities for better product development within the bank?
I think it's still at the early stages, honestly. I think there have been great advances in the use of data within marketing from the standpoint of customer targeting, segmentation, pricing, optimization. I think it's been well used in risk, particularly around credit risk and fraud to an extent. Areas like collections are pretty sophisticated. But if you think about the different ways that banks can create value in terms of acquiring new customers, growing their relationship, managing retention, reducing their costs, managing their risk, I think there are still lots and lots of opportunities. Just one way to think about it is, if you could point the same level of insight that you point to direct marketing to customers internally at how you support your employees to be more effective, that alone, I think, is an enormous opportunity. The other thing that I think has happened is that traditionally in data, you needed very sophisticated quantitative analysts to build bespoke models for different purposes. Now the tools are hiding a lot of that sophistication and making it much easier for someone working in a marketing or a risk or an operations department to take advantage of that technology without necessarily having to have a PhD in statistics. And so I think that is starting to help. And on top of that, the move to cloud computing, the standardization of platforms that I mentioned earlier, means that a lot of the data that you'd like to get access to is becoming much more available. So I think we're still really at the early stages when I look at the opportunities that a company like Quantium, for example, has. The world is their oyster, really.
And HyperAnna is a perfect example of that data analytics platform that Reinventure invested in as well. So I think you're right. I think there's a long way to go there. You mentioned fraud, and you mentioned I wanted to introduce the cybersecurity elements as well. Banks have very sophisticated cybersecurity capability. Is there a way to go there also, as you see increased activity in the Indo-Pacific, as state actors start to outsource their cybersecurity requirements to private contractors at scale, and as they become far more targeted and specific out of Eastern Europe, for example? Are you finding that that the resistance and the ability to fight back is as sophisticated within financial institutions, or is there room to improve?
Well, there's always room to improve, and it's a never-ending battle, I think, inevitably. I think in terms of the technical protection around hacking and the like, it's improved pretty well. I think the banks are pretty secure. I think they've got, certainly the Australian banks have got pretty good understanding of how they need to architect their systems to protect them at various levels. And there's a lot of good tools around that. The bit that remains really hard is the human dimension. I continue to think that probably the biggest risks are internal risks from, either bad actors internally or staff who just aren't being careful enough, and the risk of introducing backdoors and the like through phishing attacks and those sorts of things. That worries me a bit more than industrial level penetration.
And do you think that was exacerbated as people were forced to work remotely, and the systems that were once designed to protect use because you were centralized in a building suddenly were tested as people had to access their systems from home?
So in some sense, yes, and in some sense that's actually helped, because if banks have the right systems in place, they can monitor much more carefully the traffic that's coming from different devices. But yes, I mean, inevitably, there will have been situations where allowing people to work from home, if you haven't established the right perimeters around your systems, that could introduce some risk.
I'm interested in the sort of reskilling or the retention of skills that you didn't want to lose to competitors. Clearly, banks have large workforces, and there's a lot of corporate knowledge that's held tightly within banks. The last thing you want is for thousands of people to walk out the door. What is the thinking around, the reskilling, redeployment, and the retention of valuable skills?
Well, I think this goes to some pretty fundamental things about culture and how you create an environment where people want to work and want to stay. And for me, it starts with people feeling that you actually care about them as individuals, and the way that you look after them while they're working, and the way that you help them develop their own careers and capabilities. And I think companies that make people feel that they personally are valued, I think are a long way ahead. I think the second thing is making sure people understand the why of the company. And we're fortunate in Australia, and I think we're seeing this around the world, that people feel that they have options to go work elsewhere. And people are looking for a sense of meaning about where they work. And that is about purpose. It's about values that are expressed through the behavior of the senior leaders, that are expressed through the decisions that the organization makes about who it deals with and how it treats its customers. And so I actually think a lot of this goes back to some of those fundamental things. So yes, of course, it is about making training available. It is about giving them tools to help them manage their careers. But I would say that trying to solve it through tools and techniques, as opposed to the fundamental underpinnings of a strong leadership culture, is to slightly miss the point.
It's been a wonderful conversation. We have COP26 starting in Glasgow in a couple of days' time, and an entire generation asking what next and how can we accelerate the move towards net zero. Banks have and financial institutions of all kinds have a really significant role to play in their investment decisions. As we close off this conversation, I'm interested to hear what you think the challenge will be for decision makers, be they young people choosing careers, young people making investments, or even at the other end of the spectrum, investment managers deciding where to put capital.
Well, I think, again, it comes back to understanding the values of the organizations that you're looking at, be they as a potential employer or as a potential investment. Certainly, when I was at Westpac, we took very strongly or felt very strongly about our position as a leader in sustainability. We were nominated as the world's most sustainable bank quite a number of years in the last 20 years. And that was because we felt it wasn't window dressing. It was a genuine sense that people came to work for us because they knew as an organization we were grappling with these challenges to move things forward. Of course, for a bank, it's always difficult because on the one hand, you want to support the economy because that's your job. But on the other hand, as a big organization, you have an ability to stake positions that other companies, be they your customers or business partners, can learn from it and follow along. And there's an ongoing dialogue with government as well. I don't think there's a simple answer to this, but I do think it's something that the most successful companies will genuinely try to grapple with and deal with honestly and be willing to take some risk on.
Brian Hartzer, this has been a wonderful opportunity and I'm grateful for your time. Thank you so much.
Thanks, Maria. Nice to talk to you.